June 18, 2020. Munich. 1.9 billion euros. That's the number Wirecard couldn't find. Not misplaced in a filing error. Not delayed in a wire transfer. Gone. For 2 years, auditors had asked the same question. Where is the cash? Wirecard's answer had been consistent. 2 banks in the Philippines, trustee accounts, partner networks. The money was there. They had the statements. On June 18th, those banks issued a letter. The accounts Wirecard claimed held nearly 2 billion euros had never existed. By the end of the day, Wirecard's stock had collapsed. By the end of the week, the CEO was in custody. And by the end of the month, one of Germany's most celebrated tech companies had filed for insolvency. This is the story of how it happened.
Charity. The setup. Wirecard was founded in 1999 as a payment processor. By 2018, it had become a pillar of the German economy, valued at 24 billion euros, a member of the DAX 30, the country's blue-chip stock index. It processed digital payments for airlines, hotels, and retailers across Europe and Asia. The company's pitch was simple. We make online transactions seamless. And for nearly 2 decades, investors believed it. Markus Braun ran the company. Austrian, PhD in computer science, a man who spoke in precise technical language and rarely gave interviews. Under his leadership, Wirecard's revenue appeared to grow exponentially. The company reported profit margins that made competitors envious. Analysts called it the future of fintech. By 2018, Wirecard was worth more than Deutsche Bank, and the entire edifice was built on fiction. The mechanism. The fraud had a name in accounting. Round tripping. It works like this. Wirecard claimed massive revenue from what it called third-party acquiring, processing payments on behalf of merchants in Asia. The TPA business, according to Wirecard's filings, generated hundreds of millions of euros in annual profit. The problem was that most of this business didn't exist at the scale Wirecard claimed. Here's what actually happened. Wirecard created a network of shell companies in Dubai, Singapore, and the Philippines. These companies had names. They had bank accounts. They had contracts with Wirecard. On paper, they looked like independent partners processing real transactions for real merchants. In reality, they were controlled by Wirecard insiders. Take one example, a company called Al Alam Solutions, based in Dubai. Al Alam was listed as one of Wirecard's largest partners in the Middle East. According to Wirecard's filings, Al Alam processed tens of millions of euros in transactions every quarter. The company had an office address, a corporate registration, even a website. But when investigators visited the address in 2020, they found an empty office suite. The company had no employees. The website had been created using a template and contained stock photos. The bank account existed, but the only transactions flowing through it were transfers from Wirecard and transfers back to Wirecard. Al Alam was a ghost, and it was one of dozens. Money flowed from Wirecard to these shell companies, then back to Wirecard, sometimes through multiple intermediaries. Each time the money moved, it was booked as revenue. The cash never left Wirecard's control, but the accounting made it look like the company was generating enormous profit from its Asian operations. This is how the fraud worked at scale. Wirecard would transfer 50 million euros to a shell company in Singapore. The shell company would pay a fee, say 5 million euros, and transfer the remaining 45 million to a second shell company in the Philippines. That second company would book the 45 million as payment for merchant services, then transfer 40 million back to Wirecard. The 5 million difference would be recorded as profit. On Wirecard's balance sheet, this sequence looked like a real business transaction. 50 million out, 40 million back in, 5 million in fees, 5 million in profit. But no merchant ever received a service. No customer ever made a purchase. The money simply moved in a circle, generating the appearance of revenue with each turn. The auditors, EY, one of the Big Four accounting firms, signed off on Wirecard's financials year after year. They did so because they couldn't access the Asian entities directly. Wirecard cited local banking regulations, client confidentiality, partner agreements. The auditors relied on documents Wirecard provided, bank statements, transaction records, contracts, all of them fabricated. EY did request confirmations from the banks. Wirecard provided them. The letters were forgeries, produced by Wirecard employees using stolen bank letterhead and fabricated signatures. EY never called the banks to verify. They accepted the documents at face value. The 1.9 billion euros Wirecard claimed to hold in trustee accounts in the Philippines was the anchor of the entire scheme. This was the cash that supposedly backed all those phantom transactions. As long as auditors believed that cash existed, the rest of the story held together. The moment someone actually called the banks, the entire structure collapsed. The crack. The first person to notice was Dan McCrum, a journalist at the Financial Times. In 2015, McCrum started publishing articles questioning Wirecard's accounting. He pointed to irregularities in the company's Asian revenue. He interviewed former employees who described phantom transactions. He traced the shell companies and found that many of them had no employees, no offices, no operations. McCrum's first article focused on a Wirecard subsidiary in Dublin. The subsidiary claimed to generate massive profits, but when McCrum looked at the Irish corporate filings, the numbers didn't match. Revenue that Wirecard reported to investors was nowhere to be found in the subsidiary's local filings. The discrepancy was in the hundreds of millions of euros. He published the findings. Wirecard's stock dropped briefly, then recovered. Over the next 3 years, McCrum published more than a dozen investigations. He traced payments to the shell companies in Asia. He found contracts that listed merchants who didn't exist. He spoke to former employees who described being told to fabricate transaction records. He documented a pattern. Wirecard would acquire a small payments company, report explosive growth from that acquisition, then quietly write down the value of the company years later when no one was paying attention. Every article was met with the same response from Wirecard. This is a coordinated attack by short sellers. The company published press releases accusing the Financial Times of journalistic misconduct. They filed criminal complaints with German prosecutors, alleging that McCrum was part of a conspiracy to manipulate the stock. And remarkably, the German financial regulator, BaFin, sided with Wirecard. In February 2019, BaFin took the extraordinary step of banning short selling of Wirecard's stock for 2 months. The regulator claimed there was evidence of market manipulation, not by Wirecard, but by the journalists and investors who had questioned the company. BaFin launched an investigation into McCrum and the Financial Times. The investigation found nothing. But the message was clear. Criticizing Wirecard was a liability. By 2019, pressure was mounting. Short sellers had lost hundreds of millions betting against Wirecard, but they kept publishing research. Former employees kept talking. And Wirecard's own auditor, EY, was asking questions internally that the firm couldn't answer publicly without breaching client confidentiality. In October 2019, under mounting pressure from investors and facing a shareholder revolt, Wirecard made a decision. They would commission an independent audit by KPMG, a competitor to EY. The mandate was simple. Examine the Asian operations, verify the cash, and prove the Financial Times wrong. KPMG spent 6 months trying to verify Wirecard's cash. They requested documents. They contacted the banks. They interviewed executives. They traveled to Singapore and the Philippines. They asked to see the trustee accounts. Wirecard stalled. The company said the documents were confidential. The company said the banks required special permissions. The company said the trustees were unwilling to cooperate due to client privacy. KPMG kept asking. In April 2020, KPMG issued their report. It was careful, hedged in the language of audit caution, but the conclusion was unavoidable. KPMG could not verify the 1.9 billion euros.
They could not confirm that the trustee accounts existed. They could not confirm that the cash had ever been deposited. The report stated, explicitly, that Wirecard's books did not reconcile with observable reality. The stock began to fall. Wirecard issued a statement saying the KPMG report contained errors, that the firm had misunderstood the structure of the trustee accounts, that the cash was real and the company would provide proof shortly. The proof never came. On June 18, 2020, the two Philippine banks, BDO Unibank and Bank of the Philippine Islands, issued formal statements. The trustee accounts Wirecard had claimed for years, the accounts that supposedly held nearly 2 billion euros, had never existed. The accounts were fabricated. The bank statements Wirecard had provided to auditors were forgeries. The cash was gone. The collapse. Wirecard's stock lost 62% of its value in a single day. Markus Braun resigned as CEO on June 19th. He was arrested hours later on suspicion of false accounting and market manipulation. He posted bail and was released, maintaining his innocence. John Marsalek, Wirecard's chief operating officer and the man responsible for the company's Asian operations, disappeared. He was last seen in Austria on June 19th. A week later, Interpol issued a red notice. Intelligence agencies believe he fled to Russia, possibly with the assistance of Russian intelligence services. As of today, he has never been found. On June 25, 2020, Wirecard filed for insolvency. The company owed 3.2 billion euros to creditors. Investors had lost billions. Thousands of employees lost their jobs. The collapse was total. The reckoning. Markus Braun went to trial in December 2022. German prosecutors charged him with fraud, market manipulation, and breach of trust. The prosecution's case rested on a simple claim. Braun knew. He knew the cash didn't exist. He knew the Asian operations were fabricated, and he continued to sign financial statements certifying that Wirecard's books were accurate. The trial is ongoing as of early 2025. Braun maintains that he was deceived by Jan Marsalek and other executives, that he did not know the cash was missing, that he believed the accounting was accurate. His defense argues that he was the victim of a conspiracy within his own company. The evidence suggests otherwise. Prosecutors have introduced internal emails showing that Braun was aware of discrepancies in Wirecard's Asian operations as early as 2017. One email, sent by a senior finance executive, explicitly warned Braun that the trustee account balances could not be verified and that the company might be exposed if auditors pressed the issue. Braun's reply, "Handle it quietly." Prosecutors have shown that Braun personally approved the creation of some of the shell companies. They have demonstrated that he received warnings from multiple employees, including an internal auditor who resigned in 2018 after Braun refused to investigate the Asian discrepancies. They have presented testimony from former executives who claim Braun was not only aware of the fraud, but actively directed parts of it. Braun sold 26 million euros worth of Wirecard stock in the months before the collapse. His legal team argues this was routine portfolio management. Prosecutors argue it was insider trading. Jan Marsalek remains on Interpol's most wanted list. He is believed to be living in Russia under state protection. After fleeing Germany in June 2020, Marsalek was spotted on airport security footage in Vienna. From there, the trail goes cold. Intelligence reports suggest he flew to Belarus on a private jet, then crossed into Russia by car. Some reports claim he is living in Moscow. Others place him in a resort town on the Black Sea. None of this has been confirmed. Russian authorities have not responded to extradition requests. There are credible allegations that Marsalek worked with Russian intelligence before the collapse. German investigators believe he may have provided financial services to covert Russian operations in Europe, using Wirecard's payment network to move money for intelligence fronts. If true, this would explain why Russia granted him sanctuary. The money, the 1.9 billion euros, was never real. It existed only in Wirecard's accounting system. Some smaller amounts, perhaps 50 to 100 million euros, were moved offshore and likely embezzled by executives. But the bulk of the figure was simply invented. The cash had never existed. Investigators recovered roughly 40 million euros from shell company accounts in Dubai and Singapore. Compared to the claimed 1.9 billion, it was nothing. EY, the auditor that had signed off on Wirecard's financials for more than a decade, paid a 12 million euro fine to BaFin for negligence. The firm did not admit wrongdoing. EY's internal review found that its audit teams had followed standard procedures. They had requested confirmations, they had reviewed documents, they had assessed risks. What they had not done was call the banks. BaFin, the regulator that spent 2 years investigating journalists instead of Wirecard, issued a public apology. The head of BaFin, Felix Hufeld, resigned in disgrace. A parliamentary inquiry found that BaFin had a culture of deference to successful German companies, a reluctance to challenge firms that were seen as national champions. No criminal charges were filed against the agency or its leadership. Germany's financial establishment was humiliated. Wirecard had been the pride of German fintech. Politicians had praised it. Angela Merkel, then Chancellor, had lobbied on Wirecard's behalf during a state visit to China in 2019, pushing Chinese regulators to grant Wirecard a license to operate there. Olaf Scholz, then finance minister and now chancellor, had met with Wirecard executives multiple times. The Bundestag launched a parliamentary inquiry. The inquiry found systemic failures in oversight, a culture of deference to successful companies, and a regulatory apparatus that was designed to protect firms, not scrutinize them. Witnesses testified that Wirecard had hired former BaFin officials as consultants, creating conflicts of interest that the agency had failed to disclose. Wirecard had been the pride of German fintech. It had been held up as proof that Germany could compete with Silicon Valley. And all of it had been built on a lie that a single journalist had seen through in 2015. The lesson. What makes Wirecard different from Enron, from Theranos, from the frauds that came before it, is not the mechanism. Round-tripping is not new. Shell companies are not new. Fake accounting is not new. What makes Wirecard different is how long it lasted in plain sight. The Financial Times published detailed investigations for 5 years. Short sellers published research. Former employees spoke on the record. And the fraud continued. The auditors signed off. The regulators looked the other way. The stock kept rising. Wirecard collapsed only when someone picked up the phone and called the banks. The 1.9 billion euros was the keystone. As long as auditors believed that cash existed, the rest of the fraud remained hidden. The moment the banks said the accounts had never existed, the entire structure fell in a matter of days. This is the story of Wirecard. A fraud that was not hidden in complexity. A fraud that was not the work of a lone criminal. A fraud that required the complicity, or at least the negligence, of auditors, regulators, and an entire financial system that chose not to ask the most basic question. Where is the cash?